The largest gold scam of the century. Appearances can be deceiving. After all, if you put lipstick on a pig, at the end of the day, it's still a pig. In this day and age of digital tracking and triple checking, how on earth did a company get away with using fake gold to scam overseas investors out of billions of dollars? The story is truly unbelievable, like something out of an Ocean's 11 movie. You wouldn't want to miss it. Corporate greed. It's a tale as old as time. There have been plenty of examples of small, almost unnoticeable changes put in place by big corporations that have added up to a huge saving. Take American Airlines, for example. By removing a single olive from the salad served in first-class meals, they saved a whopping $40,000 a year. That's a year's salary for some people. We pay for that olive, we want that damn olive. Or car manufacturer Volkswagen's nose growing longer than Pinocchio's by claiming their diesel-powered cars were clean-burning and fuel-efficient. In reality, every car is equipped with defeat device software designed to detect when the car was undergoing emissions testing, cheating the test by only producing 2.5% of the pollution it does during normal operation. So sneaky. These cases of greed and deceit pale in comparison when you take a look at Kingold Jewelry's criminally ingenious plan that is so out of this world, it actually worked. For the uninitiated, Kingold Jewelry is one of the leading producers of 24-karat gold ornaments in China. It's a major brand with world-class designs, renowned quality, and supplies to wholesalers around the world. It was founded back in 2002, and at last glance was the largest gold processor in the Hubei province, even getting listed on the NASDAQ exchange via a backdoor listing process. Its sales have grown from $30 million in 2006 to over $2 billion a year now, a meteoric rise in value that really took off after being listed on the US stock exchange and opening an office in New York. But what happened? Stock plummeted almost overnight, decreasing in value by 60% as a mad rush of panicking investors dumped their stocks. Trading is now suspended. Not the first gold scam, won't be the last. Before we dissect this insane story of brazen bald-faced lying, let's take another look at a scrupulous scam by some mastermind Australians. This is hands down the largest example of fraud in Australian history. It has cost the government, and by extension the taxpayer, $550 million. The real figure could be easily double that or triple that amount. This scam is as brilliant as it is simple. When someone buys gold as investment-grade stamped bullion, bars, and coins, there is no 10% tax payable. However, that same tax applies to the sale of scrap gold, anything from cheap jewelry to melted-down fragments and everything in between. A syndicate of fraudsters soon figured out that if they bought large quantities of legitimate stamped gold, they could break it down and sell it for scrap, netting a 10% profit margin to the tune of $1,500 to $2,500 per kilogram. Despite a government investigation and an arrest for fraud, the situation has not changed. It is difficult to determine legitimate transactions from fraudulent ones in an industry that is only lightly regulated. This is child's play, though, when compared to what happened with Kingold. Who, me? Amazingly, Kingold initially denied any wrongdoing. You have to admire the level of steel nerve it takes to be openly defiant in the face of grave accusations backed up with hard evidence. The case against Kingold is airtight. The company is alleged to have used over 83 tons of fake gold bars to secure a group of loans from local Chinese and offshore investors. The only thing real about the story is the warehouse that stored the phony bars. If, and that is if, the gold bullion were real, they would account for $4.75 billion in value, or the equivalent of 22% of China's annual gold output, and 4.2% of its total gold held in National Reserve. In reality, they were nothing more than counterfeits, albeit extremely good ones. The stamps were nearly flawlessly identical to bars that were inspected for their authenticity. On the outside, they looked the part too, a shiny, deep gold in color. A scratch beneath the surface, however, reveals the truth. They were nothing more than copper ingots, forged and stamped into the shape of a real gold bullion, and plated with the precious metal to avoid suspicion. The dodgy bars were used as a collateral to secure a massive $2.8 billion in loaned funds to a company that was reportedly already tanking as it struggled to produce reliable profits for its shareholders. Sneaking in the back door. For those unfamiliar with the complexities of the stock exchange, a backdoor listing is a sneaky way to get a spot into the US market without having an IPO or initial public offering. The way this is done can be described as a reverse merger. Essentially, the foreign company who were unsuccessful in getting listed via the usual channels looks for an already publicly listed company that is not viable and no longer capable of making a profit. The private firm buys this otherwise worthless public company, becoming a single entity, with the private company's shareholders getting public company shares as well as cash in exchange for acquiring the firm. The process is extremely quick, and all that is left is to change the name back to the private firm's previous entity, in this case, Kingold Jewelry, and voila, a US market listing with no IPO. Warning signs. In its shareholder report, Kingold Jewelry actually admitted a $24 million loss for the 3-month quarter ending September 30, 2019. Alarm bells are ringing, especially when compared with $13.2 million of profit for the same period in the previous year earlier. Sales had fallen 40% as a reaction to their CFO or Chief Financial Officer quitting in June. In hindsight, the rats were deserting the ship before it began to sink. The fact that it needed such a huge amount of loan money as a bailout was a further warning sign that trouble was on the horizon for the company. Let's face it, no jewelry company keeps massive quantities of gold worth billions of dollars and twice the value of the company itself locked away in a warehouse to use as collateral for loans. Companies like this don't have a rainy day fund that big. The idea is not even plausible. Is using gold as collateral the norm? Owned real estate, publicly traded equities, and stocks are common liquid assets accepted as collateral by Chinese financial institutions. Actually, precious metals such as gold, silver, or platinum are rarely used, except within the mining and refining industries themselves. In saying that, some banks do accept gold bars or bullion as collateral. The reason is that high-purity bars are tradable on the Shanghai Gold Exchange, where Kingold Jewelry is listed. The catch is that owners of the precious metals are required to store the bars at the stock exchange's warehouse beforehand if they want to use them to make trades. How do you know it's real? Stamped gold bullion or bars are supposed to go through a process of metallurgic assaying and testing before they're moved to designated warehouses. The purity must be confirmed and is typically carried out by a government-certified office. It's the only impartial way to ensure that the bullion or bars produced by a gold mint meet the purity standards and content. There are about a dozen of these certified laboratory offices spread around China. The hiccup occurred when Kingold's gold bars, which were actually copper knockoffs, were examined by its loan lenders, as well as state-controlled PICC Property and Casualty, which approved the insured bars for 30 billion yuan worth of the jeweler's loans. Kingold's assets are also said to have been inspected by the Hubei Provincial Assay Office and the Gem Certification Center at the Chinese Universities in Geosciences in Wuhan, lending further credibility to the lie that the bars were real. Somewhere, someone is lying. A fake certificate, fudged test results, money greasing palms to get the lie across the finish line. How was the money given out? In China, borrowers are required by lenders to provide fresh or virgin gold directly sourced from accredited producers or refineries. The accreditation may be from authorities or statutory associations such as the Chinese Gold and Silver Exchange and the London Bullion Market Association. Gold bars with the accredited refinery stamps are usually then sent to designated vaults, such as the Precious Metals Depository at Hong Kong International Airport. Vault operators and lenders will send independent assayers to inspect the authenticity of the stored bullion. The chances of receiving fake gold bars are extremely slim, as there are so many fail-safes and checks in the process leading up to the transfer of the lent funds. Lenders will not accept gold bullion acquired from secondary marketplaces. Usually they're required to sell secondarily sourced bullion first to an accredited refiner who, in turn, will smelt and recast the bars, shipping the new gold with its stamp to the lenders for loan assessment. What happens to Kingold from here? The Kingold jewelry scam is China's largest loan scandal by value and is being investigated by various authorities. A similar instance of fraud occurred back in 2014. Where a private metals trading company called Decheng Mining duplicated warehouse certificates for copper and aluminum stored in Qingdao City warehouses and pledged the stock as collateral for bank loans. The scam was estimated to have resulted in $3 billion of losses for a number of Chinese banks and foreign financial institutions like Citigroup and trading houses such as Mercuria. Steel products were acceptable as collateral between 2009 and 2013. when China's economy was swamped by easy credit from the $570 billion infrastructure stimulus spending after the global financial crisis. During these years, steel traders were told by loan assessment officers that they could move an encumbered batch of steel products to a different warehouse and use the same batch as collateral against another loan from another lender. In a similar but smaller crime, the Jiangsu Shente Steel Group was found guilty to falsifying warehouse certificates of steel products between 2013 and 2014 to dupe 5 banks to the tune of $640 million. Its finance department chief was sentenced to 3.5 years imprisonment by an intermediate court in Anhui province early this year. The backlash. There is some precedent set by the US, and in particular the Trump administration, when it comes to protecting the country's interests against foreign companies. The Kingold jewelry scandal may be the nail in the coffin after a recent string of dodgy dealings by foreign-owned companies. Chinese tech giant Huawei is in survival mode after the US released new guidelines on the export of semiconductors to China from the US. They state that any foreign company who seeks to import semiconductors based on American patented design has to apply for a license with the US Department of Commerce. The kicker is that the Department of Commerce has the power to just deny the request. This follows a ban put in place in May last year on American technology exported to Huawei and other countries that manufacture electronics using American tech. The Chinese government threw all of its might and resources at Huawei to make sure it got a large piece of the pie that is the 5G network rollout contracts in countries around the world. All the US needed to do is ban the export of semiconductors in order to put a stake in the heart of Huawei's ambitions. In a scary case of déjà vu, a recent bill has been passed that could lead to almost 1,000 Chinese companies being delisted from the stock exchange. Though the bill is not country-specific, it's inherently targeted to cripple Chinese companies listed in the US that are either state-owned or have close ties to the Communist Party of China. It contains 2 main restrictions. The first, that companies are required to certify that they're not under the control of a foreign government. Secondly, an American watchdog must be able to audit the accounts of a firm for 3 consecutive years. If either of those conditions are not met, the company faces delisting. The bill was put in place in the aftermath of the Luckin Coffee scam. It was a coffeehouse company founded in 2017, with a grand entrance to the US NASDAQ via an IPO in 2019. Its shares rose over 50% in an extremely short time, but a huge fraud was unveiled when it came to light that the company was exaggerating its sales for the year by over $310 million. The aftermath. The fallout was American investors lost their money, in an eerily similar circumstance that is happening right now with Kingold jewelry. There is a possibility that the lost money is making its way into the hands of the Communist Party of China, and that the precedent has now been set to bring in harsher laws and measures. At the end of the day, it's about protecting the wealth of US citizens, who as investors are the ultimate losers in these scams. There is a possibility that the Trump administration will seek to impose a blanket ban on the listing of Chinese companies in the US market, with a reasoning belief if a company cannot play fair, it cannot play at all. What happens from here remains to be seen. There are new details being reported daily as more and more facts are uncovered by investigators and the media surrounding this gigantic deception. Looking at what has happened in similar cases in recent years, the future is looking uncertain, with no clear resolution in sight. Will cooler heads prevail, or will there be another knee-jerk xenophobic reaction from the government in an attempt to protect the interests of the people? Only time will tell.